Hey, it's Rob. Welcome to Everyday Investor, the hottest investment show in the world. That's right, I said it. I don't care who knows it. This is, I'm super excited about this show. We have my friend Rae Ostrander with us. If you don't know Rae, many of you saw him. We did a full day workshop for the Everyday subscribers, and that's a good reason to subscribe. Go to everydayinvestor.com and make sure you're part of our email list. Because we're going to be doing more all-day workshops. But Rae is a founder of Green Thumb REIT. But really what Rae does is he makes money. He makes money for investors. He's a much sought-after trainer. He's spoken and partnered with Robert Kiyosaki's outfit, Scott McGilvery's outfit, stages all over North America. And we have him here talking about, you know, these times in our market. Interest rates are cranking upwards, and he's here to teach us all about that and introduce an investment opportunity as well. Don't go anywhere. We'll be right back.
Hey guys, Lee here, Wise Construction. May 18th, Sarah Larby, Ken Beckendam, and myself, Lee Pollock, we're putting on a masterclass at our shop, 979 Main Street East. And what we're doing is we are going to be talking about converting larger multifamily projects from commercial to residential. During this, we're going to show you guys and teach you guys and explain to you guys on how this works, the process, the particulars. We're going to talk about the financing, and we're also going to go and see some of these projects that we've done. We're going to talk about these projects that we've done, and we're going to talk about the numbers and how they work, and we're going to answer your questions. This is all good stuff. Hope to see you there.
The mortgage world has changed. Has your advice? Are you looking for a modern approach to your mortgage planning process? Advice tailored to your unique, ever-changing circumstances? Whether you're upsizing, downsizing, purchasing, or refinancing, the Kyle Ford Mortgage team works with individuals and companies to custom tailor the right mortgage product for you. Working with a wide selection of lenders, we're here to serve our clients and help them achieve their real estate and retirement goals. Contact the Kyle Ford Mortgage team today, Canada's mortgage choice.
Hey guys, Omar Khan here from Theta Trading. I want to talk to you today about emotion and investing in the markets. Now, when the markets are doing really, really well, we tend to get very, very high. We're like, nothing can go wrong. And when the markets go lower and they correct, we start thinking the end of the world's coming and nothing can be worse. The idea is to never get high and never get too low. Always remain even-keeled. Stay within your framework. Don't get too exuberant. Don't get too down. Remember, the markets work in cycles. The idea is to be in high-quality stocks for a long period of time. Don't let your emotion destroy your investments. Back to you, and we'll see you next week, guys.
Hey, it's Rob. Welcome back to Everyday Investor. As I said in the intro, super excited to have my friend, teacher here, Rae Ostrander, and he's going to be teaching us, some things, his personal thoughts around the uncertain times that we're in. But Rae, let's start off with an example of what you're thinking in and around investing. I know you're a big fan investing where returns are the best, and that is not necessarily in the greater Toronto area. So I'm just going to pass it over to you, and why don't you give us a real example?
Yeah, sounds good, Rob. I think that the big question I think we all have is now a good time to invest? And for me, that's only answered by the numbers. So if we can look at this example, I think we can do three things, hopefully in the 23 minutes that we have here. Number one, we're looking at the analysis of a deal in general. Number two is what happens if we're trying to force financing right now? And number three, which is somewhat connected, is what's the impact of interest rates on this? Because that's the big concern that most of us have. So let's take a quick look at an example, and then we'll walk through this, and it should be able to help us with those items. So the first thing that we want to try and figure out, what is this deal? This is a property that I actually sold, so you'll forgive the lack of presentation quality here, but it was just a quick example of a property that I sold last year that someone purchased. So they made a new purchase of this property. They purchased it for about $2.3 million. And what I want to walk through and quickly show you, at that time, the income on the property was $196,000 annually. Now you'll see on this sheet, there's a number of expenses that we go through. We've included things like management and repairs and maintenance, vacancy. In this case, there isn't a lot of vacancy on this particular property. So these are actual numbers along with other contracts, again, actual numbers. And what you'll see here at the bottom, the most important thing is the total represents $94,000. That's just right over 50% expense ratio, which is reasonable for an asset that's been purchased in this time period. Obviously, these things depend on how much capital expenditures we have and how we're allocating for that. But I don't want to focus on that too much. I just want to say that we'll use these consistent numbers across all the scenarios. I just wanted you to see those quickly. And now what I'll do is I'll just simply hide them to make this a little easier for us to see.
So what you're saying, Ray, is basically the income on this property was about $200,000 and your expenses is about $100,000. And in today's era, that's about right, about 50% expense. And so you're going to use these numbers as you go forward.
Exactly. And what we obviously would do with all of our underwriting and due diligence is confirm, how much was spent by the previous owner, what do we need to do based on our inspection of the property, what's the condition, and we can put our CapEx budget in place. So what I've done is I've just gotten rid of the expense line by line and have a bottom line number that we see right here. The income was above it, and it gives us our net operating income. The net operating income is really where we want to focus. This is what our banks and our lenders are going to use. And what you can see is approximately with a 5% cap rate, the property is worth about $2,050,000. Well, that's not what they paid for it. They paid $2.3 million. And why would anyone pay that? Well, many people were buying sub-5 cap rates over the past year. Now, what happens when we do that is we have to have some type of a plan. Now, I'm not sure what this person's plan was, and it wasn't like there was one person. We had a number of bidders on this property, and it's why I wanted to sell the asset. I don't think it was worth $2.3 million, but that's what we were able to get. So when they went to look for financing on this, they had to go down, and essentially they're looking at getting a mortgage of $1.5 million. Now that represents approximately 75% loan to value. How can they do that? They can't. And I'm just going to scroll down. And what you'll see is the debt service coverage ratio is 0.85. What we typically need to see is about 1.2 to really get anyone serious in terms of permanent financing on this. And they've got to be realistic numbers. So on this particular property, there's no way that they could get it financed. And that was one of the challenges that they had. So they were looking at what were their other options. Well, they could put down more capital. That reduces our leverage returns. They could get a bridge lender. And that's the other example that we're going to look at here. Because if we scroll back up for a moment, lots of great ways to get a bridge lender in. Because in this case, now the bridge lender is looking at what can we improve the property to? What are the plans? How much is the buyer going to spend? What can rents go to over what period of time? What's their history of being able to do this? Other assets? All of those things go into the equation for the lender. But you might have found a lender who was interested in providing a loan, but what would that loan be at? These loans are plus 10% in some cases, depending on the size of the loan, et cetera. So we'll show this quick example. We can see, first of all, that if we look at the 60% loan to value option, it doesn't really work. 60% loan to value is just too much money to put down, and it still doesn't meet the coverage requirements. So as a result, they had to go with a bridge, which is exactly what they did. So in this case, the bridge loan was for $1.95 million. Now this required that they were going to put $300,000 in. That was about $12,000 per unit, and then some additional capital expenditures that were required by the lender. So they were going to have to put $300,000 in of their own money on top of that, plus the purchase price. Now that's a very high loan to value, but the lender was comfortable with it. Now because it's interest only, it is at 10%, the payments every year are $195,000. Much higher than if they were amortizing this because the interest rate is so high. But they're not paying back any principal, and as a result, it keeps the ratio where a bridge lender might like to see it. Now that's just under 1, but basically at 0.9 for the debt service coverage ratio, a bridge lender might be comfortable with that as long as they see a way for this to exit. And that depends on the appetite of the lender. Now today, you may be a lender if you're watching this show. This may be what you do today. Different people evaluate this differently. Here would be some of my concerns. The assumption in this case is that they took this property from about an average rent of $700, and they're saying they can move that to $1,000 for the average rent. Is that possible? Well, the lender's responsibility, if you're the lender, will be to go out and look at comparable rents, figure out what that market has to offer, look at the analysis from the buyer and what they've put together, and see if it makes sense. In my opinion, that did not make sense in this particular market. And I happen to know they have not been able to achieve those rents on average. However, it doesn't mean it wasn't possible or that the lender didn't think it was possible at the time. And if they believed it was possible, that will increase the income dramatically. So we see the income here at $276,000, a dramatic increase. The expenses aren't going up that much. There's some percentage increases that we put in, but as a result, they're now looking at net operating income of $170,000 per year, $173,000. At a 5% cap rate, that moves the valuation up to $3.5 million. If they buy this property for 2.3, put 300,000 in, and then can justify a value close to 3.5 for a $900,000 profit on what ends up being about a $650,000 investment, that's not bad. And that's the pitch a year ago, okay? So what's the danger with this? The danger is the exit strategy. So a few things that can happen here that are concerning is when we try and go from bridge to permanent financing, if we were able to hit our objective, and within that period of time, now maybe that's a 2-year window for the bridge, 2 to 3 years, if they were able to hit that $1,000 average, they did well. And if you're trying to do this in states or provinces that have rent control, you can imagine the challenge of trying to get 40% increases in rent across the board, even over a 2 to 3 year period, can be extremely challenging. It's not impossible, but you have to know the level of difficulty to make that happen is very high. So a very experienced manager might be able to do something like that. So let's say that they did that and they were able to get that result. Perfect. Now they go down and they have to get financing. So at this point, they're looking to be able to take out the $1.95 million mortgage that's in place. They'd love to get more back if they could, right? Take some equity out for themselves. It's not going to happen in this scenario because, as we can see, at a 5% interest rate, amortized over 25 years, their payment would be $136,000 a year. That leaves them with cash flow of only about $37,000. Now, what that means is their coverage ratio is where it needs to be. It's 1.27. So in this case, we know exactly what their capital investment is at this point. It's around $850,000 when we take into consideration closing costs. And from there, we're able to see that their return on investment is approximately 16.5% annually. That's what they're looking at. Rav, we put in a 5% appreciation expectation. Is that reasonable? I think that might be a little high in sort of normal situations. Over the past 8 or 9 years, it's been a little higher. What are you using when you're doing this with other guests and when you're doing analysis?
Yeah, I mean, that may seem a little high right now. I mean, 12, 13%, kind of thing. But, again, I just want to remind the reviewers, the question that begs is this the time to invest? And Ray's going through these numbers to be able to look at. My guess, the answer is yes, always, but it depends where.
Absolutely, and where we can get the right numbers. So I've put in about a 5% appreciation rate. That seems to me to be a reasonable number. Over the next couple of years, am I expecting that? No, I'm expecting that as an average. I think we're going to see a decline in prices. I don't have to be very sophisticated to be able to figure that out. So if we put in 5% for this assumption, this would mean that the investment would produce a return of about 16%. That's good, and you've noticed that I've put this as the fortunate one. They bought the property, they increased the rents, they refinanced it, they haven't pulled out any equity, but they've been able to replace their debt. So that's critical. The next piece, obviously, is where do we go from there if we didn't quite hit our rent totals of 1,000 and we got less? Why don't we do that after the break?
Hey, it's Kyle from the Kyle Ford Mortgage team. So, rates are in the news. What do we do? So many people ask on a regular basis, I hear rates are going up, should I lock in? The answer always depends on your personal situation, your current rate, short and long-term goals. But as a whole, variable rates tend to do better than fixed. The number one concern I hear is, I would totally go variable, Kyle, but the thought of that payment going up keeps me up at night. Did you know that there are lending products that exist that get the best variable rate mortgages, however, come with a static mortgage payment? That means as the Bank of Canada makes these changes, your payment will stay stable. If you're interested in learning more about these products and how they can be a part of your portfolio, don't hesitate to reach out to myself and the Kyle Ford Mortgage team.
You've always dreamed of having rental income, but buying a rental property? Well, that's a tall order. Capitalize on the space in your home instead. Renovate and rent out that space with ease with LegalSecondSuites.com and the team at Wise Construction Group. With LegalSecondSuites.com, our talented team of BCIN designers, engineers, carpenters, and tradespeople can transform that unused space into a beautiful, legal, and safe rental unit. We're empowering the everyday homeowner to become an extraordinary landlord. Get more out of your home. Visit LegalSecondSuites.com for more information.
Costa Cavellos, founder of First Access Condos, and here is Everyday Investors Tip of the Week. Everybody knows that we have a huge shortage of supply, real estate supply, in the GTA. This is going to get worse and worse. Over the course of the past year, many projects have been delayed. That means less products going to come to market 4 to 5 years from now. Where are you going to be 4 to 5 years from now? Owning product that's in high demand or wishing that you bought? FirstAccessCondos.com, register, and let us explain it to you.
All right, it's Rae Ostrander here. I'm with Toor. We were talking just before the break about what happens on this deal when we're trying to go from our bridge to permanent financing. We had the number one good solution that happened. Let's look what happens if we don't quite hit our objectives. So jumping back to the board here, we can see the first one we just looked at was the fortunate one who hit the objectives. They got their $1,000 in rent, the $300 increase. What happens if we didn't test the market effectively and we only got 150? If we only got 150, this presents a big problem for us because we can no longer get 75% loan to value. In order to meet our debt service requirements, we're only going to get about 65% loan to value. At 65% loan to value, you see what happens is we don't get as much in terms of proceeds from the loan. We actually are short. We can't pay out the original investor. That presents a problem if we don't have cash. Now, if you did have cash that you could put into the deal, then you would be able to pay off the previous first mortgage holder, and you've got into this deal. You've got a little bit more capital invested, which we see here, which is our capital invested goes up to 1.2 from about 850, but it still produces about a 9% return annually. This is not horrible by any means. The problem is the cash flow is only 2%. So it really begs the question, why did we get into this deal in the first place? Was it to make massive returns on appreciation? Well, that didn't work. Was it to make great cash flow? No. Could we have even looked at this back in the original state? How much more did we need to do? If we went 60% loan to value originally with less capital, we're getting 0.5% in cash flow. Our overall returns are 6.5%, but we didn't have to spend any of the money or take the substantial risk, and we would still get sort of natural inflation on the rents. That might be a better strategy than doing all of this work if we've misunderstood what the market can produce in terms of rent. Let's look at an even more difficult situation.
So Rae,
Yeah.
because there's a lot of people that speculate,
Yes.
right? And speculate. I mean, to be honest, if we buy anything pre-construction, we're speculating, as an investor. So is it wrong to speculate, or is it wrong to speculate if you don't think you're speculating? But it's speculation.
Sure. It's certainly not wrong to speculate. I just don't like to speculate. I have a low risk tolerance. I'm young, I'm about 47, but I feel like I don't like to lose money. So I'm not going to use substantial amounts of my overall net worth in speculative plays. I put the overwhelming majority into things where I feel like I'm getting steady income and low risk. So it's personal preference. What your point was, which is great, is if you don't know you're speculating and you're speculating, you may be misreading the amount of risk that you're taking on any given play.
Yeah, perfect.
Okay, so the difficult, the unfortunate one, or the really unfortunate one, what happens? Well, in this case, they don't get the rent bumps they're looking for. They get $800, which is a $100 increase, which is still relatively substantial when the average was $700. So it's still a big increase. But the problem for these guys they got two problems. And I wanted to illustrate this because one of the concerns that people have today is, what if we get caught in a situation where we're doing a flip or a value add, and when we went in, the interest rate is, just pick a number, 5%. And when we go to refinance after we've completed the work, the interest rate's gone up 200 basis points. So I wanted to give you an example of what happens in that scenario. So in this case, we'll do this at 7% interest. And what you'll see, the problem is, the most we can get for a loan, if we're going to meet our debt service requirement here, this gets it to 1.29, was $1.15 million. That's all we can get. Because we've got to be able to service the higher interest rate at $97,000. The ratios don't work for us unless we essentially put more equity in. And if we did that, we could get a 6.5% return. So some of you might be thinking, well, if that's my worst case scenario, it's not so bad. And I would agree with you. If you get a 6% return on a deal that didn't go well, that'd be great. The problem that I don't think people get, they get it when it happens, when they try to refinance, is you're going to have to come up with the difference. We have a $1.95 million mortgage we got to pay off. All we're getting is 1.15. Where's the other $800,000 going to come from? I mean, if you got it in your jeans, that's great. But typically when we're in an environment where interest rates are going up, the economy is generally struggling, do we have that liquid capital? Can we raise it easily? And can we raise it if we're working with investors or partners, do our partners want an overall return of 6.5%? I don't think they're going to put up the $800,000 to get 6.5%, especially when they're getting less than 2% in yield if they're looking for yield. So it doesn't look that bad, but it's just never going to happen because you're never going to get the cash. And if you don't get the cash, now all of a sudden you can't get the deal done and you're forced to liquidate the asset. And this is when things start to go bad. So I don't think we're there yet. But the whole point that when Rav and I were talking about this was, is this a good time to invest? And the answer is absolutely. Here's why. We must exercise a little bit of patience. Because are we seeing people in default situations or coming to the ends of their terms and they don't have the ability to renew because they weren't able to meet their pro forma projections? That is definitely happening. And it will continue to happen over the next 6 to 12 months and beyond if interest rates continue to rise and or we don't see values or significant increases in income. If the income doesn't go up, the intrinsic value of these assets don't go up from a lender's perspective. And as a result, these people are forced to sell at a reduced price. Or could you step in and provide some financing? Maybe, if the conditions were right. So whether you're a lender or an equity partner or you're doing these deals yourself, all three of these scenarios create great opportunity. There's really no time like the present to invest. I'm excited about it because if prices are going down and income is remaining the same or going up, the interest rates don't make as much of a difference as you might think. I did a quick little back of the napkin math here just to show this. On $1.95 million, we see that's the capital, the debt in each of these scenarios. Same amortization, 25 years in each situation, and then 5%, it's $136,000 a year. 6%, $150,000 a year. At 7%, it's $165,000 a year. So even if We got the increase to 165 from 136. We'll call that $30,000. We have a $30,000 increase in our debt service with the rent bump of $150. That was increasing the rent on this property by $40,000 a year. It's not going to hurt our coverage. We actually get more cash flow. If we were willing to buy this property a year ago at that price, why wouldn't we buy it today at a lower price? I'm excited about this, Rav, and I guess that probably shows. But these are the opportunities that we can find today to be able to do some creative financing, work with vendors who need some help. It's just the whole market has really turned on a dime here.
So Ray, where are you going next? I mean, here we are, summer 2022. Where are you investing? Where are you looking? I know you're buying, large apartment buildings. Where and why?
So for me, it's always about where can I get these numbers? And as a result, 3.5 years ago, we went to the US and I had begun selling some of our assets. And last year we sold the last of all of our partnerships and limited partnership deals in Canada. And we want to put those funds into the US. I've actually been sitting in cash for over a year because I look at these numbers and I go, I'm not interested in this. This is not what I'm looking for. I need to make sure that I've got slightly better returns. I'd like to see cap rates in and around 6 to 7% in place. Very challenging to get over the past 2 years, 3 years. But now, when we're seeing interest rates go up, for people who are having challenges because they're in this situation, or even this situation, both of these situations here require more capital. And if they don't have it, there may be an opportunity where someone's motivated to do a deal if we can move quickly. So for me, I'm sitting in cash, looking for those options. I tend to focus in the Midwestern United States. So I'm in places, I know you love Michigan, you're down there a lot, but Ohio, Kentucky, Indiana, we're looking in Iowa. All of those markets are great because they give us far better numbers than these. If I could, I would invest in Canada. Across the country, I just don't see cap rates that are rising above 4 and 5%. I looked at a deal just down the street from where we're taping this, and it was still under 4% in Malton. And I grew up in Malton. I love Malton. But Malton is not exactly the best market out there.
So Ray, if people are watching, Rav's watching, I've got $100,000. We think you're a smart investor, want to get involved. What do the returns look like? I've got $100,000. What do the returns look like for me?
Well, Rav, if you're looking to invest $100,000, obviously we're excited about taking on new investors. One of the things for your viewers that need to be considered is, what are you looking for? What is it you want out of the investment? Because if you're wanting cash flow, deals like these didn't make sense for cash flow. But most people say they want cash flow, and I'm assuming that's what you're looking for.
Absolutely, cash flow.
If we're looking for cash flow, I think it's on the investor to look at the offering memorandum and take a look. Are you buying an asset that has any likelihood of providing positive income? You look at all the fees, you break it down. So I would obviously send you that documentation. You could look at that. I think we're a great fund for being able to provide, we pay 7% distributions, so that's a 7% yield annually. We pay them quarterly. And that's just a great opportunity for people who are looking for income. Overall returns are about 12 to 15% on average annually. So that's great. But what other things can you be doing? I think there are opportunities to invest probably right in your backyard if it comes to providing mortgages. Are people in difficult situations where they're going to need some assistance? Could you lend money in those environments? Cross-collateralize assets. Look for different ways to be able to control your risk. I think there's lots of great opportunities coming up for that as well. And if you had $100,000 you were looking to invest in the US, you will find cap rates down there, 6 and 7%. Makes a huge difference if you're going through the numbers. I know you mentioned we might do some type of a workshop. We can walk through some of those examples in more detail.
Perfect, man. Thank you so much for doing this and being on the show with me.
Awesome, it's great to be here.
And thank you guys for watching. Without you, we would not have a show. To watch this again, please go to everydayinvestor.com, click on episodes. You can watch this right on demand or any of our other shows. Until then, we'll see you next week, same time, same place. Also, we'll be doing a workshop, so make sure that you go and subscribe to our email list because we'll do a workshop on this topic, exclusively for everyday investors. Bye for now, honey. I love you. I'll be home soon.